in the world and how you can use it to borrow money for free. Yes, ladies and gentlemen, I'm talking about a secured line of credit with 0% interest that is available to anybody who dreams of free money and has an internet connection. And if you think that's impossible, then I'm very glad you are here, because I was once just like you. At the very least, you doubt this number, and you would be right to do so. 0% interest is considered ludicrous in the financial sector. Not to be confused with ludicrous. But I beg you to please reserve your judgment until after you've seen this video, and then let me know what you think and if you plan on trying this system out for yourself. My friends, let's not kid ourselves. Borrowing money is a fact of life. Everybody has to borrow money at some point. The question is, where do you go when it's time to borrow? Do you go to your local bank? Or maybe you go to your friends. Some of you might even strike up a deal with your local mafia. Personally, I would never borrow money from the mafia. You never know. One day you might just miss a payment, and I'm rather allergic to crowbars and anything else that could cause me a lot of pain. You could go to your friends, but before you borrow money from a friend, you better decide which you need most, because Do-Re-Mi money has broken up more friendships than all the love triangles combined. So I suggest we just focus on banks and see how they do things. Credit cards. Every time you use one, you are borrowing money from the bank or from a credit card company like Visa. Either way, the money you borrow comes at a price. First of all, you have to pay a fee every year just to even have this card. Secondly, interest is the price you pay for borrowing money, right? So they say. So you are charged interest every month based on the amount that you still owe, usually around 20%. Damn is right. That can add up pretty quickly. But banks do have some better options for their more reliable customers. For instance, a bank can also lend money at a lower interest rate using something called a secured line of credit. The interest on those are about 4 to 6%, much better than a credit card. But question, when it comes to interest, how low can a bank really go? Can a bank charge 3% interest? Probably not. Inflation alone is usually about 3 to 4% a year. So at the very least, they would need to beat that if they want to make any money, right? Okay, next question. Can a bank charge no interest at all?
You're not very bright, are you?
We just said no to 3%. If a bank charges no interest on their loan, how on earth are they going to make any profit? Aha! What if a bank doesn't care at all about making any profits? A bank like that doesn't exist. You're right. You probably wouldn't find a traditional bank that gives out loans at 0% interest. But that's why I'm not talking to you about a traditional bank. The world is changing, my friend. I'm talking to you about what I like to call a crypto bank. Protocols that live on blockchains like Liquidity and liquid loans. These are possibly some of the greatest financial creations of this age, at least in my opinion. But before we dive in, let me be upfront. I think the traditional banking systems that we have today are not very nice. I think the priority of a traditional bank is to take what is in your pocket. So they smile and they wave and they show just enough concern to lull you into this dream world where you think that they are looking out for your best interests, when really they're designed and built to feed off of your income for as long as possible, with things like high interest rates, fees, and a whole bunch of semi-hidden penalties. It's just like the Matrix. Here are the banks, and here are the users, locked in pods. If you're not careful, you'll become a slave to your debt and work your entire life just to pay off the interest on your loans. Not the principal, the interest. And the banks don't mind. That situation is great for them. Never-ending payments. Who wouldn't like that? They get rich, you stay where you are. And this is very sad because it is in fact possible to have financial systems that are not by default working to strip its users of all their money. That is why I think systems like liquid loans are the future, because they're the only financial instruments that I know of that work to give everybody the full range of what is actually possible with your money. You are about to see that crypto banks are way better than your traditional banks. Way better. And liquid loans is the best secured line of credit this world has ever seen. Ready? Let's go. Now I'm sure you know exactly what a secured line of credit is, but let's pretend that you don't, for the sake of the people who don't, which is not you. A line of credit is basically an agreement between you and a bank. You give the bank something valuable as a guarantee, and in return, they let you borrow money up to a certain limit based on the value of that something. The most common form of a secured line of credit is called a home equity line of credit, or a HELOC, which is very fun to pronounce. In a HELOC, the something valuable that you provide as a guarantee is a house. Usually your own house. Unfortunately, you can't put up somebody else's house. I wish you could, but you can't. Moving on. So today, we are going to compare a HELOC to a crypto-powered liquid loan. So as we said, in a HELOC, you use your house as collateral. The maximum amount of money you can borrow from the bank depends on the market value of your house. Usually you can borrow up to 80% of the paid off value. Naturally, the bank wants to know that you can pay back the loan with interest. They also need to know that you're not just gonna up and run away with the money, right? So they need to know all your personal information. They also need to know both your credit and employment history. And if your record is not up to snuff,
no soup for you! Come back 1 year! Next!
After you get the loan, the bank needs to make money, so they charge you interest on any amount that you owe. And sometimes the amount of interest you pay can change based on market conditions. So it can be 4% 1 year and then 6% the next. And at that point, you just have to suck it up and keep making your payments, even if they're higher now. It's not my problem. Should have read the fine print. And finally, there's usually a timeline on when you have to pay back the entire loan. You can't just keep the loan out forever. And that's basically how a HELOC works. It's not bad. If used wisely, it can be very useful. Do not take out a loan against your house and go and YOLO it on a meme coin. What's wrong with you? Anyway, a HELOC is good, but borrowing can be much, much better. Time to look at liquid loans. First off, let's start by pointing out that a HELOC is given to you by a bank run by emotional and often greedy little human beings, whereas a liquid loan comes from what you call a smart contract. It is computer code that lives on the blockchain. It runs itself and automatically executes functions. If A, then B. If no A, then no B. People can build and deploy smart contracts to do a number of things. One of them being, if a person is able to provide a certain value in the form of a specific asset, give that person a USD line of credit based on the value of that something, specific asset. And this works because the loan is backed by the value of what is locked, just like a HELOC. So let's keep comparing. Change that name. Instead of a house, you use a cryptocurrency called Pulse as your collateral. Pulse is the native token of the PulseChain. PulseChain is like Ethereum, but much better. If Ethereum was Squirtle, PulseChain is Blastoise. Now I know what you must be thinking. Cryptocurrencies are extremely volatile. But like my man Richard Hart says,
Volatility is the price you pay for the world's best performing asset.
The question is, overall, is the asset appreciating or depreciating? Because if overall the asset is appreciating, then as long as you get in at a decent time, say really early on or on a major dip, then my friend, you will be fine. You'll be very fine. It is great, no problems, no issues. What is the problem? Let me give you an example. If you took out a $10,000 loan backed by a $500,000 house, and over the next year, the value of your house drops from $500,000 to $400,000 and jumps back up to $600,000, during that whole time, your loan is absolutely fine. In fact, you could borrow even more if you want. And there's no denying that a crypto project with product market fit, just like Pulse, appreciates way more than real estate. It's not even close. Ethereum did a 10,000x in 5 years. If Pulse is better, well, I trust you to use your imagination. The smart contract only cares about the market value of the Pulse that you put in your vault. It doesn't care about your history. It doesn't care what you look like. It doesn't care where you live, where you're working, if you're married, how many wives you got. It doesn't even need to know your name. Do you have the value, and did you put it in your vault? Those are the only two questions that matter. So get that out of here. Now to the main point. Liquid loans doesn't charge you any interest at all. 0% interest. Zero. It has a small one-time fee to activate your loan, usually about 0.5%. Peanuts. It's nothing. And this is possible because computer code doesn't need or want to make any money. It doesn't have a board of directors looking to squeeze out as much profit as possible. It doesn't have employees to pay. It doesn't need to pay rent. It doesn't need to pay insurance. It doesn't need to pay child support. It doesn't need to pay a car loan. It doesn't need to pay anything. It is a blockchain-powered smart contract with the sole purpose of locking value and giving out loans. That's it. No one entity controls it. No one can stop it. Not even the fantastic people who built it. And since it runs on one of the most efficient networks in the world with extremely low fees, this digital bank can stay open 24/7, 365 days a year. In a HELOC, you can borrow 80% of the value. With liquid loans, you can borrow up to 90%, 90.9% to be exact. That means if you want to take out $2,000, you would need to put a minimum of $2,200 into your vault. Another way of saying this is you need to keep a minimum collateral ratio of 110%. If the value of your collateral drops below that 110% ratio, then the smart contract will simply take your Pulse and consider your debt completely paid off. That is one of my biggest selling points with liquid loans. Unlike traditional banks, it will never ever let you go into debt. You never get stuck with a loan that you can't pay off because the value that you need to pay back your loan is always there. The worst case scenario is this. You put up some Pulse, you take out 90% of its value, the price of Pulse drops, you go below your 110%. The protocol keeps your Pulse and considers your debt paid off, but you already took out 90% of its value, so really, you only lost 10%. And as far as worst case scenarios go, that is beautiful. But if you're like me, and you don't want to lose any Pulse at all, then you make sure that you keep a safe collateral ratio in your vault. Mine personally is gonna be at 1,000%. So that means that if I want $2,000, there's going to be $20,000 in my vault. The price of Pulse will need to drop by 90% before any of my Pulse would be at risk. It gives you that power. You control how safe you are. It's beautiful. Now let's talk about the best case scenario. I don't want to lose my Pulse because I know Pulse's potential. In my mind, Pulse could do a 10,000x like Ethereum, or it could do a 6.5 million x like Bitcoin. I don't want to miss any of that. That is the best case scenario. The value of your Pulse just keeps going up even after you take the loan. That means the value of my collateral ratio just keeps going up because the USD loan that I took, that value doesn't change, but my Pulse is getting more expensive. It fluctuates, but it's going up, so I can keep borrowing more and more if I want. You don't need to make minimum payments, and there is no time limit on when you have to pay back your entire loan. If the price of Pulse does something similar or anywhere close to what Ethereum did, and you are wise with your borrowing and your collateral ratio, then technically, you could just keep borrowing real money backed by the market value of your Pulse that just keeps going up, and you never have to pay back your loan. Ever. So now I hope you can understand and share my sentiment when I say that protocols like Liquidity and liquid loans, banks that are open 24/7, 365 days a year, that let you take out secured loans at a 0% interest rate with no questions asked, no paperwork, no middleman, no hassle, and absolutely no delay, could be some of the greatest financial creations of this age. My friends, if that is not the future of banking, then I don't know what is.